Good afternoon, folks. I'm having some issues with the audio, so if it's low, because it appears to be not giving me a high enough volume, it is what it is. You're going to have to deal with it. Okay? It is what it is, okay? All right, so we've had a pretty wild day today. It's been a fun day for me. It's been pretty busy. But if you look at what we have here going into the last hour of trading, we have had a lot of this messy little attempt to get higher in here. And they pumped it up one more time here. So I'm waiting to see if we get some kind of a attempt to work out of this buy side balance, sell side inefficiency. It is Friday. I like the idea of profit taking in this hour. I'd like to see if we could mount a break lower out of this area in here. If you look over here in the new day opening gap for today, these lows down here, I like them. I like that right there. Do we get down there today before close? I don't know. It's been rather aggressive in its attempt to keep driving higher, and anyone trying to go short today, unless you know exactly what you're doing, has probably been a little difficult for you. Now, if they really want to take it to the extreme, we have relative equal highs up here. Oh, he's playing both sides. Yeah, I want to see how we close the macro at 1050 to 10. I'm sorry, 250 rather. Sorry, 10 minutes to 3 to 10 minutes before and 10 minutes after 3 o'clock. So the 250, 310 macro. Tongue twisted here today. I have landscapers here again, and I tried very hard to find a room in my home, but they're all around the house, so there's no real escaping it. So you're probably going to hear them in the background. Hopefully not, but there's nothing I can do about it. Take a quick look at ES. You can see it's rather ugly, admittedly. Actually, let's look at the YM. All right, so we have the Dow failing to make lower lows in that area. For ES, you can see we had lower lows there. And NQ, it's pretty much flat. Okay, so it's kind of similar to what the Dow has posted. If we have any rally above this short-term high, it would need to do it inside of the macro. So in other words, 250 to 310. If it takes this high out here, then I would look for it to run to these highs as we go into the close, which to me would be amazing because it's been pretty much hugely manipulated this week. Like, it's absolutely ridiculous how it's been one-sided and they just keep driving it higher and higher and higher. And that's how you know it's the Fed. So if the lows here are taking out between now and 310, then I'll look for continuation to go into maybe this low. And it doesn't need to go all the way down to that new day opening gap for today, the 13th new day opening gap. But it could make an attempt to try to gravitate towards that as we go into settlement today. It's real important that you see what's in this market structure. We have very conflicting things. So whatever I outline here today will be very, very short term. I don't have very strong convictions on either side, which is why I'm requiring that 20-minute macro at 250 to 310 to kind of like tip its hand to me. Normally on a Friday when we had a large range up close weekly candlestick forming, I like to see a 20 to 30% retracement. Now, that's asking a lot for this particular week because it's been an enormous range for the week. So I think in that case, it's probably not likely to do a 20 to 30% retracement if it were to retrace at all. And nothing really says that it has to do that at all. It could stay inside the range. And this is one of the things that's problematic. And I was watching this as 245 came this low and this high. We could stay inside that range going into the close of today and really do nothing. It's just mark time going sideways. If they do that, then that means I would really like to see a gap opening higher on Sunday and then come down, work into that gap as a closure, and then slowly bleed into higher prices. I have almost a romance with the 19,695 level. And I believe that it's too smooth. Okay, so it's too smooth. And while I was very hopeful that it was going to be like traded to either today or overnight last night, it didn't do that. I mean, it's obviously gained some ground moving towards it, but it hasn't done everything like I wanted to see it do. See how we're just working inside that old buy side imbalance, sell side inefficiency. So this is one of those times where, because it's kind of like trapped, not a trader being trapped, but price is kind of like stuck in between two different types of scenarios where technically, if we were just looking at this part of the move, like right here, from this low to that high to where we are right now, I would favor that as a short. But because we have had this stop hunt over here with this drop down, all of this movement here and then coming down to this area here, to me, it's conflicted because it could be used as sweep these short-term lows and then rally into the closing hour. So it's not as easy for me to sit here today and outline this, but I'm going to do my best, okay? Because I promised I'd be here, so it is what it's going to be. Okay. So we just made an attempt to try to get down below that short-term low in here. So these are relative equal lows. It's 1 minute after 3. And I left my cell phone on the other side of the house, so not to brag, but it's too much of a walk to go get that right now, do a check on the audio. So I'm kind of like winging it here. I'm not sure if you guys can hear me well. If you can't, you know, it is what it is. So obviously you've seen a lot of setups today. I shared a lot of activity on Twitter. Twisting the knife. I was supposed to get roasted today on YouTube. I guess that got canceled. All right, so we had this drop here. Watch how we have this candlestick right here. That right there. If that stays open and we break all the way down to take out that low, well, then we can take a look at maybe something like this. There's a new day opening gap, and it's the high of it. So one of the things I like to do is I use the new day opening gaps and new week opening gaps. So it's not just something that would be applicable to just the end dog. The gap opening on Sunday, you can use the same type of measurement as well. So we have a inefficiency here down to an inefficiency. This area right in here, that's consequent encroachment. But if you use the quadrants like this. The 25, 50, and 75. In this area in here, that's event horizon. So what I like to see is, does the market have the ability to draw down into that? Because there's two inefficiencies here, this one and this one. So the optimal level, obviously, would be to see it trade down to its midpoint here, consequent encroachment. That is the event horizon. But setups can form for either continuation into existing trades or targets, like low-hanging fruit objectives, that type of thing, could be used for the upper quadrant and lower quadrant. But specifically, it's this level. And what I do is I watch, and I'll always have this on my chart. So when I'm trading, you see examples of me executing and managing trades, my eye is actually jumping to these things because I can see where they're at approximately. And I'll give you an idea. Like, this is where it's at here, measuring it, obviously. But if you take it away, you should be able to determine from the low of this buy side and bound sell side efficiency to the high of this inefficiency, roughly it's about that price point right here. That's about halfway. So what I do is I'm looking for price to try to gravitate to that level. If I wanted to go down there, everything that would be a premium array, if price were to start dropping down, I would look for up close candles to keep price from going above it. And I would look for any fair value gap that would form. I would like to see the upper half of it stay open. So all of those things would be signatures to kind of like support the idea that it would be reaching down into event horizon. So if we didn't have all of the backdrop of this over here, because this could still just do what I was mentioning earlier, just taking out the short-term sell side here, that's not enough. Like it's got to move and show real displacement. So I want to see it at least give the indication that it wants to move aggressively, and it hasn't done that. It just drift below that. And it's 3:05. So we have about four and a half minutes or so left on the macro at 250 to 310. Then we'd have to sit and wait until 315, because 315 to 345 is the next macro. And what is a macro? A macro is a short list of directives, like a script, okay? And imagine a high priority function of going through a quick series of calculations and then repricing. So that's kind of like what it's doing. It doesn't mean it starts right away at 315. Doesn't mean it ends abruptly at 345. It just means between 315 and 345, there usually is a spooling. There's a run for inefficiency, or it's a run for liquidity above old highs, or a singular high. It would run for the buy side. For sell side, it would run below a singular low or relative equal lows. For inefficiencies, it would be something like I just outlined down here where the event horizon was. Above us, we have this high right here. So that's a minor buy side. We've already disrupted the minor sell side. And admittedly, I would have rather seen it when it did this. I'd like to see it aggressively, at least take out these short-term highs, come back down and use the old buy side and balance, sell side efficiency over here, high. That's this level here, then to run to this high. But it hasn't done that yet. So to me, it's a little lethargic. So if we close the 253.10 macro and we don't see anything materialize between 315 and 345, that means the only thing we're probably likely to see is that last few minutes of the final hour trading, where there'll be a little bit of a flurry of something, and that's kind of like, to me, it's a dud. I don't like that. I know a lot of people get all excited about it because like it's a little flurry of activity. And it's usually the guys that are trading like 50 accounts on funded accounts, and they're trying to get their little moves or whatever. It's too much like gambling, in my opinion, for that. But it's still fun to watch. was supposed to get cooked today. That's funny. I like this candlestick here. And what I like about it is, if you look at what we've done between the low of this buy side imbalance, sell side inefficiency, and that high, see how we hit the consequent encouragement of that? Now it demands that price moves out of this to the downside. Otherwise, if it goes above this candle here, that means that we're going to run for the short-term buy side here. And in how we trade to that. So it gives me a kind of like a if this or that. So instead of saying, well, it could do this consolidation, now it gives me a candlestick where it tells me, okay, now because of time, why? Because look at the time here, 309. So I would demand that this candlestick, because it did this very thing here, it needs to break lower, because if it doesn't and it trades back above its high, which it just did there, that turns my attention to the buy side there. So it's a matter of waiting for the time where the price should move, and then you wait for price to confirm it. And then it's done nothing here. It's sitting, which is, again, going back to two scenarios are in play. And you're looking at the last hour of trading. Who's coming in right now? Who's coming in and thinking, I feel like putting a big bet on going into the weekend? No. Now, you would think, if it was buying and selling pressure, the longs have been extremely bullish all week, right? So they're the ones that are in profit. They're the ones that are heavy pockets right now. They have the most money. They made the most money this week. So wouldn't it be reasonable for it to drop lower, because they would be doing what? Selling their long positions. And that would create what? If it was buying and selling pressure, it would be selling pressure and a lack of buying pressure. We're going to use those terms. I'm making an argument. I'm not saying I believe that, but it would be reasonable to expect that on a Friday like today, because we had such a huge range for the week that's been higher. So the question is what's holding it up? What's stalling the what would traders that are already long, what would they be sitting here waiting for in this last final hour? Like, what would they be waiting for? Would you be comfortable holding the entire week's profit if you bought real early in the week, and now here you are, we're getting ready to go into the weekend? Would you be more inclined to hold into all this and think, well, it could still rally? And if it was buying and selling pressure and people are likely to take profit, and that makes the price go lower, if that's what you argue and make the case for, my question is what would it take to inspire everyone to start unwinding their long positions? Like earlier in the afternoon, I watched this drop down here on one candlestick do like 70 handles in 1 minute, which was neat. It was fun to watch that. But then it came all the way back up in here, and it's just drifted lower. So admittedly, there's few times where I'm stuck against the wall saying, I don't know how to work with this one right here, right now, but I'm willing to sit here in the event that it does give me something to work with. And I think, honestly, anyone's school of thought right here, it'd be a little bit of a bet, a wager, not so much technical, for anyone to say with conviction, yeah, I believe it's going to do this. You might say something that you might want to see. Like, I would love, personally, if I could be honest and tell you what I would really want to see is I want to see it trade aggressively above these highs and drive into that 19,600 level. I'd like to see that personally. That's what I would love to see, that, because that would, even if we don't close up there, it just means that we're probably most likely going to march into that 19,695 level eventually sometime next week. What I don't want to see, okay, is I don't want to see it fall aggressively like a TGIF, because I think personally, uh, I don't believe that that would be constructive for this type of week because it's been so one-sided and so parabolic. Like it's been violent, like almost brutal, that it's not trying to go lower. So, what is it reaching for? I mean, what would be the reasonable draw for something that's been drawing so aggressively higher? Those smooth highs on the hourly chart. All these highs over here. Now, like that's just too. Come on now. I don't care what school of thought you have. I mean, I don't care how you trade or whatnot. That's just that stuff doesn't stay in the charts. Like it just doesn't do that. It doesn't stay like that. It gets disrupted. And is it a stretch for it to be expected to happen today? I believe so, but stranger things have happened, right? But we do have this inefficiency in here. So if we were able to make a run outside of the buy side and balance sell side inefficiency, it's marked in blue over here. If we can get above these highs and then trade down to the top of that, it can wick down into the upper quadrant once it does that. And then aggressively, it has to do aggressively, run to take out this short-term high. My attention would go right there. And that doesn't mean that we have to trade above and make a higher high. It just means that I would like to see that traded too if that were to unfold. So here was short-term sell side or minor buy. I'm sorry, minor sell side, and we have a minor buy side liquidity pool here. Not there. There. Okay. Now, obviously, you've been watching my trade examples and watching how I move my stop, how I place my stop, and when the market is loose, the contrary condition of a market being loose and liquid, very fluid, it's not this. This is stagnant. It doesn't mean that it's not worthwhile studying it. It just means that it has to do something. Okay. If you go back here earlier, as I mentioned, um, because we took out that short-term high above consequent encouragement there, that tells me what it's going to run for this, and it's done so here. So now we want to watch, does the candles roll back? We don't want to see it happen on the same candlestick. I'd like to see it stay up here like this, like up here. Not don't wick it, but stay up here with a body, and then open a new candlestick and trade down. That's the type of signature I want to see. I don't want to see it do these types of things because it's quick to want to go back inside the range of that buy side and balance sell side efficiency. And again, that is this single candle over here. That's the buy side and balance sell side efficiency. So I'd like to see it. Let's see, that's too close. I don't like that. I'd like to be up here and then open and trade down. And if it did that, then I would expect the very next candle to start marching up to this level here. That's reading the tape. It still can do it. It just means that it's not my favored development for price. So as I was starting to say, um, if I wanted to take a long or a short in here, I don't have the luxury of placing a very small stop loss on it because it's too back and forth. So I always refer to this as kind of like a fuzzy price action. It's too much static. It means it's not clean. It doesn't have a whole lot of levels that are obvious. They're smooth that you can run to. There's really hardly any inefficiencies at all. So if you look at it, you might see volume imbalances, but outside of that, you're not seeing any kind of gaps, no fair value gaps. So it's being held very, very tight. So this is an efficiently delivered price range between this low here and this high here. So the only thing we can do is use liquidity. What did it take recently? That's what I was outlining over here. We could go down here and take the sell side. We've seen that. Now reaching for the short-term buy side. So we opened on this candlestick here. We traded down a little bit down into, didn't get quite down to the upper quadrant, which I said it would be permissible to see that, but it didn't do that. So because it didn't do that, is that bullish or bearish? Well, the fact that we kept the bodies, see where the bodies are? They're on the outside of this high of the buy side and balance, sell side efficiency over here. So that's constructive for a run into this area for liquidity. If you look also, I've been getting a lot of comments. Folks have been doing these measurements on their candlestick wicks, and they're like, man, I can see all this stuff happening now, how the market moves from one consequent encouragement to the next consequent encouragement. Or if I'm bearish, and I see a wick in close proximity to where I'm entering a short or holding a short, it doesn't trade up to the consequent encouragement. And then, like you said, that's usually weakness and it rolls over aggressively. Yeah, that's reading the tape. That's real institutional order flow. That's getting feedback that you're not going to get by watching level 2 data. Okay, you're not going to get that type of information. So it's a visual reference where you can measure the accumulation or distribution inside of the marketplace without having an indicator. You're just simply seeing it in the delivery of price, which is fascinating once you really know what you're doing and what you're looking for. It's fun. Like, it really is fun. It's like predicting, well, I don't know what it would be like predicting tomorrow's headlines, and if it gets close to it, or maybe, I guess I'm not a sports fan, but I guess it'd be like predicting the winner of the next big game or whatnot. And I'm watching this wick here. And I like the fact that we came down here. I like that we only wicked here and we don't have any bodies laying on top of the consequent encroachment of this wick right here. So I'll show you what that looks like. See that? Quadrant level there. And the bodies are above that wick. Now it can touch it, obviously, because did it on this candle and it's done it on that candle. But we just don't want to see any candlestick laid down over top of it. Like, say, for instance, that candlestick closed like that. That's not actually constructive for a run to that liquidity if it were to lay over top of the consequent encouragement of that. So when I'm watching price deliver and I'm using wicks and such to kind of like weigh the strength or the underlying weakness of a price run, if I start seeing those things happen, then that's usually like a canary in the coal mine. It's a warning sign that things are not as they should be. There's something going on. It's some kind of manipulation, or ultimately the setup is failing and it's running out of interest in moving higher. So I read it wrong. That's what it means. So you're constantly looking for feedback in every individual candlestick to get an interpretation of what it may be wanting to do. And since, as I mentioned, there is no inefficiencies in any of this price run, just small volume imbalance over here, which we're not really, we're not considering any of that at this time. And we had this small little gap, but that's already been utilized over here with this touch. But other than that, nothing really jumps off at me as useful, which is why you have to force yourself to do what? Use where the liquidity is. Sell side's been taken here. Buy side is here. So it's reasonable to see if it wants to run up here. What would be interesting is this. If we can send it to there and then they tank it going into the close, that would be a very interesting study to watch. So if you're trying to trade the last hour, and like say this is like your model, say you want to be trading in the final hour of trading between 3 o'clock and 4 o'clock. There are steady setups every single day that come around this time of day. but you want to be trading in a market that has inefficiencies. And obviously, there's always going to be short-term highs and lows for liquidity, but you want to be in a market environment that has both, because it gives you a plethora of opportunities, and it gives you, for me personally, it gives me reference points where I can trust placing my stop and know that I have a great deal of things behind me that are supporting the idea that I'm holding the trade for. Whereas if you don't have a lot of inefficiencies like that here, this is a very efficiently delivered back and forth. It's kind of like that paint roller analogy. A lot of delivered back and forth, all of this. It's sloppy, it's messy looking, but there's still a reason to why it's doing what it's doing. But unfortunately, it just makes it a little bit more complicated for placing a stop loss. The way I use a stop loss, I like to keep my risk manageable. And while the contract size you might look at those contract sizes and think, wow, that's a lot. But it really isn't a lot if you look at the equity size that's being utilized when you're seeing these examples being placed. Here comes that buy side. So once we pop through here, so the only imbalance that we're really framing any tape reading around is this buy side imbalance, sell side inefficiency. So it's worked its way outside of it to take the sell side, which is what I outlined during this live stream, and then up to here. So we have taken that now. So I've had a few people, I'm certain they're probably brand new students. They ask similar questions, almost in the same vein about what I'm saying here is when they ask, can you show me how to find the minor buy side and sell side liquidity pools? Well, that's what these examples are here. Okay. Because it's inside of the range that's defined by this big move here. See that? That big range there. So this low here would be a larger pool of sell side liquidity than that of what we were outlining over here. And this high here is a minor buy side where it has buy stops sitting above it. It's minor because it's part of or inside of the range from this high down to the low it's formed here. And we didn't need this low to form using this low here. If price was just there and it was consolidating in here, say before I got talking about the liquidity, so you were watching this would be minor buy side, this would be minor sell side, this would be primary sell side, primary buy side. It's relative to the dealing ranges that you're looking at. Why am I using those highs and lows? What makes those specific highs and lows specifically called on when I'm looking at the chart? Well, if you look at the time of the day, this is during the lunchtime period. So I want to look at what we've done as a low and a high during that time period. And then it'll give me the context for the PM session. And now because we're in the last hour of trading, we watch the trade down to here, sweep the sell side, no inefficiencies, just using the initial ideas of this was the high of the buy side, and this is the the low of the buy side and balance sell side inefficiency, that single candle over there. No inefficiencies whatsoever, except for that one right there that I mentioned moments ago. And then we hit the top, which I don't afford all that much attention to this inefficiency because it's more or less using the buy side and balance sell side efficiencies high. So remember I was telling you earlier, it'd be nice to see it trade above that buy side here. Trade above it and then sink it, tank it, I think the term was I used. I'd like to see a small portion of this down close candle stay open. I'd like to see some piece of that left open right there. And then we would watch and see, does it have the ability to get down into this sell side? If it leaves this portion here and starts to break lower, any movement below halfway, or this red line here, which is this single candle, which is a buy side imbalance, sell side inefficiency, that consequent encroachment midpoint level right there, if we trade down below that and we leave a small portion open, I would like very much to see this low traded to and redelivered to. But if it closes this in entirely, then it becomes 50-50, and then we have to wait for more information. What information? Wait for it to see if it wants to break lower or break higher, because it's already done enough for us to study the last hour by taking this short-term sell side here and then the buy side there. Is it something that you can trade? Yes, but I would tell you it's probably better that you didn't. And is it profitable for study? Absolutely. But it's not something that I would be all over, trying to take a trade. And you can see we pretty much almost closed that in. So that now becomes a question of what we're going to do. Are we going to keep the range that's defined with this high here now? Because now the buy side is here. And when you're working inside of primary buy side and sell side liquidity pools, I'll explain that in a second. These highs and lows I'm marking right now, these are always going to be dynamic. They constantly evolve because you're inside of the high and the low of this primary dealing range. So because we're inside of that, this high is what we were just targeting, where earlier we were targeting these lows. We had the lows hit, and then we ran up to the buy side. Now, because that high has been taken with this swing high here, and this low has been taken with this swing low here, we now move our attention to this is now new minor sell side liquidity. And now this is new minor buy side liquidity. And we constantly refer back to now, how does price behave between these two levels? That's how we work with dealing ranges. Okay, so it's an evolving concept that allows you to see dynamic liquidity that's constantly entering the marketplace. Anyone that's going to enter the market right now, they're not going to look at this high here for a buy stop, for a short protection. They're not going to use that. They're going to use this one here. Anyone that wants to break out with a buying approach, so in other words, if they think if it goes above a certain price level, if it breaks resistance, let's call it like that. Okay, I don't like those terms, but that's what they're going to think it is. They see this as short-term resistance. They could be a buyer on a buy stop that puts them long if it goes up there, expecting it runs to what they believe over here is resistance. Either way, if someone's trading short, they're going to put a buy stop right there. If they're trying to buy on a breakout, they're going to put a buy stop there. You see how easy that makes that? So that's why I don't always make a strong argument about what type of buy stops it is, because it encompasses both sides, whether it's a buyer of strength trying to enter a new long position, or if it's a short position being protected with a buy stop. That's how you protect your short position. And the same thing that's being described here for this minor buy side liquidity pool here is said with this short-term low. So this is minor sell side. So meaning that anyone that's long initially, maybe they bought down here, or maybe they bought inside here, their stop loss would be resting right below that low. Now it has potentially maybe moved up to this low, or maybe this low in here, or maybe even now this low, because we're getting late in the day. It doesn't change the fact that there are models that the stops, once they're placed, they don't move them, and just let it go. Okay, and you don't think that way, but that doesn't mean other traders or entities in the marketplace shouldn't or aren't thinking that way. So because this low is now the low that's a factor before you get to this low, the algorithm would refer to this low as a minor sell side liquidity pool. And this would be the minor buy side liquidity pool. If this one gets taken out and then it returns back into the range between the new higher high and this low, then you would define the higher high that's been formed. That's your minor buy side liquidity pool. And it just constantly evolves until you take out this high. And then you now have what? You have an expansion where you have to wait for some type of retracement, some kind of turning point, a significant intermediate term high, basically. And then you have something to work with. What makes an intermediate term high? Well, you have this high here and this high here. This high is lower than that one, and this high is higher than that one. Long term, intermediate term. So you would like to see eventually these highs taken out and create that same type of scenario where you have a high with two lower highs around it, and you have a long-term high. And anything that's subordinate or lower than a new higher high, it forms like this. That's an intermediate term high. I have a couple lectures on this YouTube channel where I teach market structure, and if you want to delve into that subject matter, it's there for your edification. All right, so we're almost 25 minutes to 4. It's like watching paint dry, isn't it? Not all that eventful, is it? Still good study. These are the days and lectures that are not fun to be a part of. They're not. It's a lot easier to hold students' attention when the market's moving around real fast and there's lots of things you can spot. But what happens when the market's trading like this? Like, what are you going to do? If you're in here trying to learn how to trade, that's wonderful. But what are you going to do when you start seeing price behaving like this? Are you going to sit down and try to force your will in the marketplace because, hey, I'm watching price, I'm sitting in front of the charts, I better take some trades, I better take a trade, otherwise I'm wasting my time? That's usually the scenario that unfolds, and that's also the invitation for regret, because you end up doing something that doesn't make sense financially just because you feel impulsive that you want to do it. It doesn't mean that the market's going to bend its knee to you, because you're trying to impose your will on it. So I saw a comment today. I don't know if I saw it on the comment section of the YouTube channels videos or if I saw it on Twitter. I don't remember which one it was, but it was more or less like ICT is basically painting so many scenarios where his students are never going to trade. And that's not entirely true. But for a troll, for someone that just wants to have content to make posts about, and the myopic, people that don't really know what it is I'm teaching, and that my students actually do their own decisions and make money with the concepts I've taught, there's a growing period that you're going to have to grow through initially. And it's going to be where you're trying to do something right away. And unfortunately, you're going to try to do everything that I teach, and you're not going to find the success that you want, that would come if you were just trying to use one approach or one PD array. Give me 1 second, please. Ornery puppies. My wife was like, I didn't know you were live. I'm always live, woman. Don't you understand? I'm ICT. So so I kind of broke my concentration there, but we'll see if I can wrestle it back into focus. The long and short of it is this: when you're looking at price like this, and it doesn't have a whole lot of inefficiencies, it doesn't have number one, where are we at in the week? We're on Friday. We're at the last little bit of time left where the market could do something, but it might not do so much. Why? Because we have this conflicting type of scenario where we had sell side taken here aggressively, and then we pumped it all the way up, spent a little bit of time here. We had this nice sell off, failure to go higher, and it just meandered lower down into that same buy side imbalance, sell side inefficiency that's over here. And then it's spent a whole lot of time in here. When we are in inefficiencies, okay, I don't like to see them spend a lot of time in them. I don't like to see that. I will feel comfortable if I'm on side. In other words, say I'm bullish, okay? If I'm bullish, we're starting to get a little bit of animation there. That's good. Came right down. Just fell short of consequent encroachment of that buy side imbalance, sell side inefficiency. But say I'm bullish and there's bullish fair value gaps, okay, or something to that effect, volume imbalances. I don't like to see price spend time in like it's done in here between these big bold blue lines. I don't like to see this type of stuff. When you start looking at your charts and going back through your old data and look at your old price moves, you'll see, because you have the benefit of hindsight, that is when the market was hard. If you were trying to trade in that, you might have been hurt. You might have been stopped out. You may have had a lot of conflicting signals, and you may have been frustrated. That's the main thing. I'm trying to teach my son Caleb to look at the market where it is not so confusing, and they're not trying to, well, not just Caleb, but all my kids, that they're not trying to force themselves into a trade. I'm going to look at these two lows here between the indices real quick. I'm using a laptop, so I don't have the benefit of having all my other charts, so it's still making a lower low there. And let's check the Dow real quick. The dirty 30. Yeah, she's got the same thing there too, so it's not all that interesting. What I'm doing is I'm doing correlation studies to see how the delivery of these lows here and here respectively, how they match or if they didn't match it. Usually if there's a higher low formed in the S&P, that's my SMT divergence. But I'd have to be bullish. It doesn't give me the buy signal, or it doesn't give me the buy bias or the to be long because it diverged. There has to be something else there. SMT is a qualifier. It's not a selection tool. Okay, it's not something that says I need to be a buyer because it's diverged between the two averages or three averages, or if you're looking at like Eurodollar and cable for the forex traders, like if you looked at my old content, you see if Eurodollar makes a lower low but pound dollar doesn't make that lower low, yes, that's an SMT divergence. But if that SMT divergence forms in an area and at a price and a time when it means absolutely nothing, even if I am bullish, it doesn't mean that that adds anything in terms of validity to the move going higher at that moment. And then eventually what tends to happen is that the SMT eventually fizzles out. In other words, it doesn't stay there. And one of those pairs will move in a way that removes that supposed SMT divergence. So what I'm saying is if there's something that is already predetermined that makes the market bullish or bearish, and I already have a PD array, something that is I'm waiting for it to trade to. And then if I look at the correlated markets like ES versus NQ and YM, or if I'm looking at the bond market, say I'm looking at the 5-year, the 10-year, and the 30-year, if I get a divergence like that, you didn't expect that, did you? If I get a divergence there, then that obviously it confirms and provides a little bit more quality behind the setup being bullish at that moment, because I have other factors there. So I'm not looking just panning through charts looking for divergences. That unfortunately is what a lot of the folks on social media were doing. As soon as I started teaching SMT, everybody was just scanning through the charts because it's a visual representation that it's easy to spot, isn't it? And that was how I thought about it when I first started trying to develop a method around that. I was like, man, I'm so frustrated. I want to see something that just jumps off the chart, because even though I had all these indicators, I didn't trust the indicators. And the fact that I had 3 or 4 of them on my chart told me that I wasn't trusting the indicators. I just wanted something to tell me what my gut was telling me at the time. I want to buy. And if one of them said it's oversold and it crossed over with a bullish divergence, I was buying it. So really what I was looking for is any excuse to go in there and do something. And that's unfortunately what everybody's trying to do, not just with my stuff, with everything. And that's that problem that's in you that you have to bring to the surface in the beginning. You have to find out what those things are that you're going to use to derail yourself. And it's impulsiveness. So I'm not sure how I got on that topic, but um, because there's no real time left in the week, I don't see us going to 19,695. I don't see that. Can it happen and make me look silly in front of the entire world doing it? Yeah, I would love that to happen though. See what I'm saying? Like I would love to see that happen. But because we have had such an enormous price run all week, like all week, this thing has been driving higher. So is it reasonable to expect the last few minutes of the trading day before the regular trading session ends at 4 o'clock and settles at 4:15? Yes, there's 45 more minutes that it trades, but why should it do anything spectacular after that? So the probabilities fall off precipitously because of the factor of time. Time is the most essential element, period. Every trade that I took today was based on time. Everything that I showed, every single thing, when I was buying and selling all day long, when people were sitting around talking in their little YouTube channel, talking about this and talking about that, the market was giving setups. It was easy movement, lots of easy setups based on time. Now we have this compression of movement in price, but it's in a small envelope of time. We only have a few minutes left. We're going down to the last 15 minutes here in a moment. Okay, so that ends the 315 to 345 macro. What we're going to now wait for is the 350 to 4 o'clock macro. You see how we just ran into that liquidity right there at the end of 345. That's what I'm talking about. When you want to look at your charts, study the macro times I'm giving you, and you'll see that that market is doing one of two things. It's driving up into some inefficiency. That would be something like this. This is a gap here, okay? Or it's going to go above an old high. That's the only two reasons why price is going up. It's not because it's buying pressure. It's not that. And the only reason why the market's going to go lower, it's going to go down to an inefficiency. And that would be something like over here or below this low here or now this low here. Okay. So because we have this low being pierced by this one and it's trading essentially at a PD array, this sell side goes here now. See how it becomes dynamic? Everything starts to evolve. And this is important stuff when it's not at the last trading day of the week, at the last 15 minutes of the trading week. Okay. It's far less useful in terms of information. But can you imagine how this is useful, say, on a Tuesday, going into 10 o'clock in the morning, where you're starting to see this compression with price action, and you can define where the buy side and the sell side is. So right now, we're above this short-term high. What you're doing is you're watching. Does it start to expand here? If it does, what would it be reaching for? There's a small little short-term high over here. See that? There's a small little short-term high right there. And there's that inefficiency right here. So what you would watch is, does it have the ability to stay above that high here? If this candlestick closes below here, then we take that line and we apply it to this candlestick there. Why? Because we have a swing high, which when this candle closes, if it closes down below it, below this high specifically, this becomes the new minor buy side liquidity pool. Got 30 seconds left. So whether you're going to trade the last hour of the day or not, it's always a useful study for liquidity. Always. It's always a study that's worthwhile. And it'll help you work with time-based trading models where you're only trying to trade in an hour's worth of time or 2 hours worth of time. And you can do all the trading you'd ever want. Now see, this is where it's at now. So your minor buy side is here. So what you're looking at, we've already cleared this high, and now we have it here. Does the market show a willingness to stay away from going back above this high and stay away from this high here? So I'm constantly referring to what price is doing right here, fluctuating back and forth in relationship to this old high and that high. As long as we keep moving away from it, and every new candle that is generated and paints on the chart moves away from it, that means that we would eventually gravitate down to this low here. Or if we drive through this, then I would want to see it reach up into here, and any bit of excitement beyond that would be a run to this primary buy side. And just for the sake of having it on a chart, I'll just put it on there, okay? It's important when you're first studying like this, if you're brand new, is try to remove the impulse. And I see all these jokers out there making up nonsense. I'm not teaching you to just try to primarily be right all the time. Okay, that's an asshole talking out their ass. Okay, that says that stuff. I'm teaching you that being right is not essential. Actually, like you don't have to have a perfect entry, but you do have to know where the market's reaching for the purposes of withdrawal and liquidity. That draw may be an inefficiency like this, or it could be an actual high, or in this case, relative equal highs. Because above that is going to be what? Buy stops. Below this lows, what? Sell stops. This little tiny little separation here, that's a volume imbalance. Let me elongate the chart so you can see a little bit better. There's no inefficiency where we're at here beyond this one. And that might, if you trade lower, it could it could trade right into that as inversion if it wants to trade down into the volume imbalance. But um, you're constantly looking for where the market may book price for the purposes of inefficiency or stops. And while I don't like to draw these levels on my charts to annotate minor buy side and sell side, I have done it recently because I want my son to see it that way. Don't think because I say I don't put it on my chart, don't think that it wouldn't be helpful to you while you're first learning. Treat it like training wheels on a bicycle. But eventually you'll get real comfortable with knowing, okay, I'm inside a larger dealing range. And trading inside the range of what? What's that mean, Michael? Like, what do you mean when you say that? Okay, so now we just broke here. So we have this short-term high, and that inefficiency right there. So I'm going to add these with the little ray thingamajiggy. Thingamajiggy, Michael, what does that mean? I can see now the foreigners, they're now trying to look up, what is a thingamajiggy? It's a doohickey. So whatchamacallit, you know what I'm talking about. It's just, unfortunately, one of those things that are slang. So we traded into that short-term high there. So now we have this high. If we get another candlestick that stays below here and it's lower, this becomes our new minor buy side. So you're constantly referring to this, and you'll see why. Learning how to do this, it's a little cumbersome, constantly moving it around. You won't need to do that once you know what it is that I'm teaching you, because you'll understand that, okay, now anything, if we start to drop off, that means that price might be enticing traders to do what? To be short. And if they're short, where they're going to place their stop loss? Above a high. You see how we ran above that high? We didn't close this candle yet, so it's still driving. There's liquidity in here, and there's inefficiency where the market wants to deliver just for the purpose of overlapping this singular down close candle. Think about it like that paint analogy I gave you. The paint was applied with a roller on the wall, and it went down. So how do you go back over this same area if there wasn't enough paint? It's got to go back up there at a later time. So that would make this a repricing to this inefficiency. That's a SIBI. This is a sell side imbalance, buy side inefficiency. It isn't sexy, but you're learning. And the more times you do this stuff, you'll be able to see the setups and trades that I was doing today, which is, it doesn't matter. Like I was trading without a bias. I was just simply trading time, inefficiencies, and liquidity. That's it. Time of day, how the market should characteristically deliver, post lunchtime, before lunchtime, during the lunchtime. Okay. So you're never going to run out of setups with me. You're never going to be short of a supply of opportunities. And that's the wonderful thing about what I'm teaching you. I give you lots of resources and tools to first determine how you want to trade. Which PD array do you like? I'm not forcing it on you like I'm doing my son. So it gives you the control. You have that control. I don't have it over you. And that's what a mentor should do. A mentor should be like, here is what's available to you right now in terms of opportunities to be a buyer or seller. I was trying to get through this before that does that, so I might have to hurry up and run and grab my power cord. ICT, you're so unprofessional, dude. Fuck you. Come on, let's see if we can get it for that. Probably can hear that guy out there running his blower. There we go. All right, so you can see we touched that old high. It's probably random. Just for moral victory, I'd like to see it book inside that blue shaded area. And I'd be content with that for this session together. But you can see how that dynamic high, and now this one here, you wouldn't need to keep that line on it anymore. You get rid of it. Sometimes you've probably seen where I've had levels annotated and then I dim them. I don't make them so prominent in their color, and almost like I fade them away. That's because I've taught somebody a very specific thing in a video. Maybe a student asked me a question, and then I demonstrate that same thing where they keep it in their chart so that we can, to journal it or study how all the time frames worked with that specific level. I know we're on a 1 minute chart here, but my students are familiar with like 45-second, 30-second, and 15-second. In my opinion, it's not necessary for you to trade below a 1 minute chart. But once you learn how to do what it is I teach, you'll probably want to do it. But it's not noise. Goldman Sachs boys, they'll tell you it's noise, but that noise was sweet chin music today, wasn't it? ICT was all over that 15-second chart. I'm waiting for this candlestick to close, and then I'll annotate that high there. But what will eventually happen is, instead of moving these levels around to teach you to observe it as minor buy side and minor sell side liquidity pools, you'll just naturally understand that, okay, this is where, in other words, it would look like this. You just know that that high has the minor buy side. You don't need to draw a short-term trend line on it to draw attention to it being where stops would rest. But in keeping with the lesson, I'll do it because this is what Caleb should be doing. And now, because we just pierced it a little bit over here, we don't need to have that there. And that's your dynamic minor buy side. And we trade it all the way down into that little area I told you about a little while ago, which was a volume imbalance. The volume imbalance is a separation between two consecutive candles where the bodies do not join. There may be a connection with wicks, but there's no overlapping or touching between the two candlestick bodies. That is a volume imbalance. and they are the most flexible PD array, meaning that yes, I can use them to put on a trade to get into it. Yes, I can use them to get out of a trade. Yes, I can use them to take partials. Um, I can add to and pyramid in them. But I also know that they are the most flexible PD array, meaning that I want my order block to be very, very strong in defending its mean threshold, its midpoint level, okay? Half of its range. It can wick below it, but it cannot close below it. If it closes below half of the candlestick that I'm looking for it to behave like an order block, if it's, say, for instance, a bullish order block, I don't want to see any candlestick after it forms trade down and close below its halfway point. As soon as I see that, if I have a trade open and it's open profit, I'm going to take half the trade off or make entirely close the entire trade off. If that is the last of the 3 PD arrays I'm using as the last ditch support behind a bullish trade that I'm in. So I'm not framing the basis of my trade being successful on just one PD array. While that one PD array may be the singular catalyst that puts me in at that specific price, the overall trade is not hinging on the basis of a order block or a fair value gap. There's other factors there. And now I'm watching the midpoint of this wick, which is consequent encroachment. And we're in the last couple seconds of the day, so it doesn't make a difference, but I'm just going to annotate it anyway. We'll see if we can drop it down and take out that sell side right here. I'd like to see it trade up, hit the consequent encroachment of that, and then dump right down to that. That'd be cool. So when you're watching price, these are the types of things you can practice with. They're like little tiny drills. You see how it's freeing. It's very liberating to not expect yourself to be right. You don't have to be right. You don't have to be accurate about an entry point, but you want to get used to seeing how price behaves and how it shows you its mannerisms. And you also need to study what the mannerisms are around certain times of the day, like now, versus the opening at 9:30 or after the first 30 minutes of trading. How does the market behave then? Okay. So I know some of you jokers that watch my videos. Not everybody watching this is who I'm referring to when I say these types of things. It's the people that don't really try to want to learn. They just want to watch something to get some kind of material to go online and complain about because it's not easy. So they want to attack it. And you're never going to make me feel bad about that. It just means that you aren't equipped to do it. And that's fine. There's other things out there. There's VWAP and there's moving average crossovers and indicators. You can do all that stuff. Lux Algo's making all kinds of crutches for all of you. And I'm not mean that to be mean. There's things that is available for everyone out there. You don't have to trade ICT concepts. You don't have to do anything that I teach. And you can flip a quarter with good money management. You can make money. But you do have to control your impulses. You do have to fix the problems that are inside of you. Because no matter what you use, until you fix you, you are going to be the reason and the catalyst for you losing all the time. There's no external factors that causes you to lose that is beyond you. You're it. You're the problem. And it's always that. I was the problem for myself. Everybody else that's become profitable, if they're honest, they'll tell you they were the problem. You're always going to be the problem. Tools and resources and approaches, they're all going to differ, but you're going to be the constant. So if you've been going through one trading approach to another trading approach, this mentor, that mentor, I tried this system, and if nothing's working, it's probably a sure sign that you're doing something all the time that's messing it up. And that's why I teach the way I do. And it's not popular in the first few months with me because it's you finding out that you're not as good as you think you are as a person. And here we go. Dig down in there. There you go. ICT. Oh my goodness. So everything that we walk through here is just a really good example of how you can go in and study the last final hour of trading. And what you'll see is over time, you'll pick up on phenomenon that tends to repeat. And you'll also be able to recognize when the market's a little bit more complex and difficult to get in versus other days where it's just the ranges are beautiful. The candlesticks are just easy to read. You can see the fair value gaps, they just jump off the chart. Whereas you see like this type of delivery, I think anyone that's familiar with my stuff, they can see this and say, okay, yeah, this isn't the prettiest type of price action. But as you can see, we can determine where it's likely to draw to. And while I wanted to see that up here trade to, it didn't get there. But it got to this high, it got to this high, and we watched how it delivered above this short-term high here. And then eventually, after it did all the things over here, I would have liked to seen it trade up into the consequent encouragement there. And if it would have hit that, I would have said, now watch, I want to see it react off of that and then trade for that sell side. I actually said that, but I wanted to see it do it. And I would say, okay, if it happens to do that, then what you can do is you can use the consequent encouragement of this wick, and that's where your stop loss would be. You don't need it to be above this high because you have consequent encouragement here that frames the setup, and that little wick, half of that measurement here, your stop would be one tick above that, and then running to that short-term sell side, that would be a very easy bread and butter setup. Now, for some of you, that went right over your head, but that is a model. That forms every single day. If you look on every time frame, you'll see it. You'll see it on these little time frames like this. You'll see a lot of it on a 15-second chart, a 30-second chart, a 45-second chart, because those charts, they're moving, a little bit more abruptly. They're not faster. They're just not staying in a big bold up close candle or a big bold down close candle. So in other words, they tend to have a little bit more wicks than they have bodies, and that's what makes these lower time frames, to me, very easy to work with, because there's lots of volume imbalances. There's actual gaps that form sometimes, which is easy because the market is going to just dump right back into it or go up into it real quick. And then once it leaves it, if it touches the bottom of it again, that's an easy entry. That's a vacuum block. And if you don't know what that is, look at the month 4 content in the 2016 playlist on this YouTube channel. Look, I mean, that stuff is just, it's basic ICT, but it's absolutely essential for someone that's trying to figure out what their PD array is. Maybe you've seen me talking a lot about fair value gaps recently because you just started following the channel and you're thinking, I don't feel comfortable with a fair value gap. I don't know what fair value gap I want to trade. Well, that's what Caleb's learning. Caleb's learning that same thing. Okay, so how I'm teaching him, that's the answer to your question that people are leaving in my other videos saying, how do you pick the right fair value gap? You always tend to get into the fair value gaps that work right because I created it. So, I mean, if I make it, it's mine, right? So it makes perfect sense that I'm teaching my son in my best ability as both his dad and his teacher. I'm teaching him my solution to finding how it is that I see it. Let's be honest. I might not be successful in communicating every facet that I know about a fair value gap to him, but at least it gives him a framework to start with, which is exactly what I've invited all of you to do by having all the content I have on my channel. Strip everything. I want to say this in 5 minutes, and then we're going to end the session. I know you want to see me keep going, but I have a life and I have something I want to get into that starts this weekend for me. Trading how I teach, okay? There are people out there that will say, I complicate things. And that's just you saying that you can't think. Like you are complicating it. You're thinking, this is too much for me to work with. I want something simpler. And if that's how it is, say that, and I'll never argue against something like that. But if you say it's a complication, then I'm quick to show up and say, tell me why you failed. Show me what you were doing. I did this with my own paid students. And when they would show me what they were doing, it's a big spotlight, huge spotlight that they're not doing the things. And then when they got to the point where they were honest with me, they would tell me, yeah, I just, I don't have the patience to do this and blah, blah, blah. Right. Now you're getting to the core problems that are inside of you. It's not the concepts, because let's just make it very plain and simple. You're either going to be a buyer or you're going to be a seller. If you're trading, it means you're bullish. Do you think it's going to go higher? You're going to be expecting it to go lower. Okay, that means you're bearish. Right away, there's your two decisions. But now you have to ask yourself, is it the time for the market to go in that direction that I want to be a buyer or seller? I could be bullish on a market and not take a trade yet because it's not the right time. There's not a session. There's a period of time between specific sessions. I'm not interested in trading. There are times when the market is very, very liquid and it's very fluid. Okay, this is not a fluid market. All these candlesticks here, while they did deliver, and you watch me outline it here in front of you, even though that it's something I admittedly wouldn't want to trade this, we can still see what it's trying to do. And when you start doing these things and you think to yourself, okay, well, it's complicated, but then when you practice like this and you start getting successful at reading where it's trying to get to, it may not feel all that big of a deal right now, but when it starts to happen in your own hands and you think, oh, I was hoping it was going to trade here. I was watching and watching and watching. I had a little bit of doubt it wasn't going to get there. And all of a sudden it did it. And that epiphany, that moment of, wow, it really just did that. It feels good. And you're going to want to talk to your friends and your spouse and say, you know, I did. They're not going to see it. They're not going to feel that same moment of astonishment that you have that are very small micro points and milestones in your progress, but they're essential and you need to journal that. You need to cheerlead yourself. But stripping it down, you're just trying to be a buyer or you're trying to be a seller. If you're trying to be a short seller, that means you're bearish. All you're looking for is a market that has a clear, obvious relative equal low or a singular low, and the market has moved in a manner that has proven its willingness to not want to go any higher. Here's a high. It trades above it. How many times? Once, twice, 3 times. And it goes to this high before it does the turnaround. That candlestick is 355. So what is occurring at that 355 time? Like, what behind the scene is going on? That's the market on close. It's the settlement macro. It's where the last little piece of volume getting shoved in the marketplace, the algorithm is going to force traders. It's not that them selling and buying it, okay? It's going to start spooling. What does that mean? Spooling is kind of like if you're a fisherman and you have your lure and your sinker and hook on your fishing rod and you cast the lure out in the water. As the fishing line leaves that reel, that's spooling off the reel. The fishing line is going away from your rod, okay? Well, when price hit this high that we talked about before it happened, it trades up to it and hits it. Once it hits it, the time element kicks in. I would have liked to seen it spike up there, admittedly. I would have liked to seen that because then I would have said, I'm going to look here, but you can clearly see when we got down to this area, I said, watch the consequent encroachment of this wick. If the next candle would have opened up and traded up into the midpoint of that, I would have said, watch and see if it delivers from here down to that sell side. Because the macro is going to do what? It's going to seek liquidity or inefficiency. So from up in the midpoint of this wick here, what inefficiency would it have? We've already hit this volume imbalance with this spike down in here. So that's not something it would want to reach for. So what's it going to reach for? What's lower than it and to the left of that? That low. And that's why I said watch and see how it dries down and see if we can get that sell side delivered too. Because the macro, it's a computer program. It's a script, folks. It's AI doing this. And what this is doing is it literally forces traders to be impulsive. Oh no, it's dropping. Let me get out of my trade. So what are they going to do? They're going to sell. They're going to sell. They're going to sell. Not because it's creating selling pressure that drives it lower. The market is offering lower prices and lower prices and lower prices. And it doesn't matter how many people are coming in to buy it. It does not matter how many people are willing to come in and buy it. Because there's only going to be what? A buyer and a seller meeting together. That's it. It's a net sum zero gain. For every short seller, there's got to be a buyer for the same amount of contracts. And then you have that price booked. So if the algorithm is constantly going to spool going lower, that means it's offering lower prices constantly. It does not matter if Warren Buffett came in here and tried to whale it in there. It's going to go where it wants to go because it's predetermined. And it's going to go right where those stops are. I know there's a lot of you out there that want to wrestle with that. It doesn't matter. It doesn't matter if you believe me. It doesn't matter if you believe there's an algorithm. But I'm telling you, look for these, we'll call it patterns. Because it's not a pattern to me, but look for these types of patterns to repeat. If you don't like to think there's an algorithm, just call it a pattern, okay? And this high frequency reoccurring phenomenon. Okay, we'll call it that. You don't want to call it an algorithm, call it that. It's there every single day. And when you start looking at price like this, it takes away, it demystifies everything. Now, true, when I was on Baby Pips, I created this lore of mystery around, what it was I was doing because I wanted to obviously draw a crowd, and I was successful in doing it. But I didn't want to teach this level of it. I didn't want to do it. But because it's my son, I want him to learn it, right? I want him to learn it the right way. I want him to start off on the good foot. I want him to learn how to do it in a manner that not is meant to rush him through it, but certainly afford him the ability to grow at a pace that's reasonable because I'm starting him with one PD array. See, if you're a student of just a YouTube channel and not going through this mentorship, you have a question to answer first. Which PD array are you going to use? And that's a problem for some people because they're indecisive. That's a problem. Just like somebody being impulsive, just like somebody being a liar or a someone that's fearful all the time, that's prone to be anxious. They're all character flaws. There's ways that you can compensate for those things, but for the folks that have to be, if you're indecisive, you have to determine which PD array you're going to start with. Unless you're going through this mentorship here, or you're going through like the silver bullet model for Cameron, or if you're using the 2022 mentorship that I made for my daughter, those very specific things, it's telling you, look at this and look at nothing else. Well, here I'm teaching my son to use the fair value gap, but he has to see some kind of attack on liquidity first. And there's a joker on Twitter that's trying to say I'm teaching my son his model. Dude, look, I don't know what you're smoking, but I've been doing this before you were out of school and before you ever started trading. And all I'm doing is teaching him to look for a run on buy side and sell side. And that might be in a very narrow range like we just outlined today. That's all that is. And then looking for a pool of liquidity or inefficiency it's going to draw to based on the time and the underlying market structure. So I don't need to copy something. And apparently you used to be a student of mine, so, or maybe still are, I don't know, but you used my stuff and I don't know who you are. And I have so many students, I don't know all of you. And some of you get offended because I don't know you. I don't know you. I don't know none of you, really. So I don't need to copy anyone. I don't need to, certainly don't want to copy a student. Okay. And I have so many other things I have never released before. Like you simply don't need everything that I've put on my YouTube channel, but you have to decide on one thing. And by creating unique models, you can have a little bit easier approach to saying what you want to focus on. But every one of those PD arrays that I've shared, and no, not all 81 of them have been released, but and I don't intend to release them either, but the idea of you picking one to start with, it still takes you back to the same thing. Are you a buyer or a seller? The market's going to go, whether you use a optimal trade entry, if you use a fair value gap, an inversion fair value gap, if you use institutional order flow entry drill, if you use the consequent encroachment of wicks to get into a trade, they're all entry mechanisms. But not every price run has every single one of these PD arrays, which is why I taught my paid students to have all those choices, because a well-rounded student of price action using the algorithmic principles I'm teaching you, which are smart money concepts, those choices that are afforded to you because you know all those PD arrays, you can trade in any time frame, in any market, in any market asset class. You can literally walk into the marketplace and say, okay, I know what I'm looking for because here it is. And that's why you see jokers out there saying, oh, ICT's got a cover for everything. Yes, I absolutely do. I don't know why that's a problem. I had a problem getting into trades. I was afraid that I wasn't going to get the right one. So I had to develop lots of ways to get into trades because my problem was I wanted to be in every move. I wanted to be in everything. So I was a madman and I stripped down price and I looked for things that were doing certain things that you can't learn about, but I'm showing you in price action. So that way you can see these things, these PD arrays, these little things that repeat. If everything is there in price where it's going to go higher for inefficiency or higher for buy stops, find the PDA rate that you're comfortable with. If the PDA rate that you're looking for doesn't form, guess what that means? You don't take the trade and you miss that run. And what does that mean for you? Do you lose your mind over that? Are you getting upset and mad about that? Why? You were right about the direction. That's the progress. That's how you mark off in your journal. I didn't get my PDA rate, I didn't get my entry, but it was very satisfying to see it go to where I thought it was going to go. And it probably went faster than you thought it was. And then you can say in your journal, it was amazing to see how price just vaulted right to this level. I'm so encouraged by that because that means I'm seeing things on the right side of the marketplace. And 99% of people out there, they don't do that. But some of you want to beat yourself up because you can't get in like an ICT entry. You can't use these ultra small little stop losses. I got to start making my stop losses bigger just because I'm creating a fit, a nervous tick in all of you. Like somehow that's just, it's not good enough unless you have a stop loss like mine. But that's just how I trade. That's how I do things. But I'm going to start using a wider stop loss in my examples because I don't want you thinking that you have to have that right now. And that's going to create a problem for you. Because if you want to go right into trading and think you're going to figure it all out real quick, and you're going to just go do it real fast with really small stop losses, and you're always going to get the right direction, and you're not listening to me because I'm telling you that's not going to happen. It takes time. These assholes out there that want to try to twist things around because they want the attention. They want to sell something. They want to encourage their buddies to do paid mentorships. Okay, all that stuff, you don't need to pay for any mentorship. There's so many people out there on YouTube, okay, that don't even trade with my stuff. They trade in front of their audience, okay? They may not be perfect. They may not be, what I would view as worth putting money behind. But if you're comfortable watching them, don't watch my stuff. I'm not going to troll anybody. I'm not going to go into your live stream and troll you. Okay, I'm not going to do that. But I will say that your shit is bullshit and that it's substandard and it's subpar. And it can't even come close to this. And I proved that today. Every single time I sit in a live stream, I tell you every single candlestick. And that's because I want you to see what it looks like, how it behaves, what should it do, what shouldn't it do. All those things, that's building a narrative. Nobody was talking about a narrative in price action until I started teaching in private mentorship. Everything in the industry has changed because of that. And that's not a brag. That's not me beating my chest. That's just the facts. And that's essential. I'm glad it's happened. That's why you're seeing so many more profitable traders in the world. They may not do everything that my concepts have brought to the industry, but certain ideas of how to look for certain types of profiles, how the market will behave, not market profile with volume and all that other stuff, but how it should deliver price. Make the low of the day first and then close on the high. Oh, that's easy. That's a classic buy day. But then there's other market profiles that tell you that it will consolidate in the first part of the day, and in the afternoon it gives you a price run. Okay, what's it going to do? It can consolidate all morning through the lunch. What's it going to reach for later in the afternoon? Well, if you don't know what the weekly and the daily is likely to reach for, you won't know that. But if you do know those things, then you know that the consolidation might just go through the lunch period, and then the lunch consolidation, they'll drop it down below when it's bullish. They'll drop it down, engage the sell side, and then pump it all the way up into the last hour of the day. When you go through all those market profiles that I teach in the latter months, I apologize. I simply do not know. It was the 2017. It's part of the day trading stuff. I don't know what playlist that is. I apologize. But it's in the latter months. I think it may be 8 or 9. I don't know. I don't want to tell you one and it be wrong. Um, but the day trading stuff where I teach very specific daily profiles, just like on short-term trading, I teach weekly profiles, how to look at a weekly range and how it behaves and how it will perform. It takes a lot of experience to do that. So don't think that you're going to watch those videos and, oh, I know how the next week's going to paint. Because you have to understand the economic calendar, what week we're in, on what month of the year, what seasonal tendencies. And I have a lady that left me a comment. Can I show how I overlay and adjust my seasonal tendency charts? Seasonal tendency charts are static charts. They're not something that I can change or augment, and they come from Steve Moore from More Research. You can Google him. He has the best work on seasonal tendencies. He has the absolute best. It's the best service you can have for seasonal tendencies. I do not get anything for it. I don't even know if he knows about me or if he even knows who I am. But I have sent so many people, I'm sure, to him. I don't get a kickback. I don't want a kickback if you're listening to me, Steve. I've always paid for the stuff, and that's the way it is. And I don't want anyone misunderstanding that the seasonal tendencies, even though they are as good as they are, and I believe in them, they're not panaceas. That means that they're not a be all end all answer. It doesn't mean that just because price is likely to go down over the next month and a half, that it will. It just means that if you have the technicals behind it and you're entering that time when it's likely to go lower, that chart helps you to trust that it's not just a 1 day trade or a week long trade. It's probably a month or more. And they're really nice times to trade if you look through his. It's not really expensive. You can go in there and do like a trial run, I think, and just take a look at some of his charts. Uh, I just I got them 2 times. Okay, I got it back in 1995, and I got it in the 2000s, and I just basically screenshot them, and they don't change a lot. So what I'm saying is you want to look at a 15-year versus a 40-year tendency. He gives you these 2 lines that look like moving averages, and you want to look at the seasonal tendencies that have both of those time measurements of what that commodity or that instrument, because he has it for every market, um, how they're agreeing, where they'll both aggressively go lower for a period of time throughout the year. He shows you a whole calendar year at the bottom, like a chart from January to December. And what I have taught and what I've done with my own trading is I focus on times when both the short-term seasonal tendency and the long-term agree, and they're moving in the same direction. Um, if you're short when it's both the long-term and the intermediate term, short-term seasonal tendencies, if they're agreeing, you're going to find that they are many times the low resistance liquidity run signatures in price that you want to be actually in, and they're really fun to be a part of. So you can basically plan when your biggest volume of trades are going to enter by using a seasonal tendency. But one of the wonderful things that I learned was when the seasonal tendency isn't panning out, that used to make me angry. I'd be like, man, I want coffee to go down. I want coffee to drop, but it wasn't. And then it told me that it's not going down as it normally would. So it means it's wildly bullish. So when I changed my stance and said, okay, I'm going to look for longs technically, because there's a seasonal tendency right now that says it's supposed to be going lower right now. Both the short term and the long term seasonal tendency for coffee at this moment says for the next 5 weeks or a month and a half, it should be bearish. But price just ain't going down. It ain't going down. Okay, well, then I'm going to look for something technical. I'm going to wait for a price run higher, and I'm going to take the first fair value gap. I'm going to buy that. And any chance I keep adding to it, I will. And you'll see that many times outperforms what the seasonal tendency would have been had it delivered, because it's telling you something that's against the grain. So you have to be uh, receptive to that, and you need to be able to be receptive to the things in price action when you're watching every individual candlestick. Doing these types of exercises, even if you don't know exactly what you're doing in the beginning, everybody feels that way. When you were in chemistry, when you were taking physics in school, in the higher math courses, it all was hard, right? Until you understood what it is you're doing. This is no different. You just got to keep showing up every single day and apply yourself. Don't spend anything, in terms of gross amount of time, because you'll burn yourself out. You'll get tired of hearing me. And it's the worst thing in the world is to try to listen to me when you're tired, because you're not going to retain anything. It's going to frustrate you, and you want your study time to be optimal. You don't want it to, oh, I'm putting time in, I'm listening to him because I don't want to hear him complain how I ain't doing enough work. Put enough in, but don't put too much in. There's got to be a balance. And if you spend too much time studying my stuff, you'll fizzle out, you'll lose energy, you'll lose interest, because it's just going to bog you down. It's very dry material. So schedule how much time you spend with it. And then when you spend time away from it doing your other things, you're going to find out that they're going to be a lot less interesting, and you're going to want to come back to studying. When you start reading price correctly and you start seeing these little moments where you're getting better at it, it's fun to be addicted to do it. Okay, that's how you know that it's for you. Because if you can't be in charts studying and seeing the repeating phenomenon and seeing how, man, that would have been an opportunity, I can see how I could have used that. That's what you're constantly looking for. You're constantly looking for that type of setup. I have lots of them. I have something for every single one of you. It may not be the very first things you start with. It may not be this mentorship with the fair value gap, but it's not just the fair value gap. I'm teaching you other things, Caleb. These other things are going to help you find the right fair value gap. That's that's the default, the byproduct, or if you will, of doing this holistic approach to understanding how price is booked. Knowing these things will help you be a well-rounded trader. And then it'll be easy for you to look at the other PD arrays and you're like, well, I understand how that might fit. I don't use a institutional order flow entry drill, but now I can see, I've watched fair value gaps enough. Now I can see, oh yeah, that must have been one of those institutional order flow entry drills. And the only way you're going to know an institutional order flow entry drill is likely to be the entry and not closing that fair value gap is when you see price action not fill fair value gaps. And you're going to discover that you're in low resistance liquidity runs when those institutional order flow entry drills form, because they don't form in high resistance liquidity runs. Oh, but see, you can't appreciate that if I say it to you because you haven't studied the difference between this type of price delivery here, all of this run here, where we can clearly see what it was reaching for. I mean, if we were in a classroom right now and I said, raise your hand if you were impressed with how it was possible for us as a group to watch and see how price was going to reach for these individual levels. I would say raise your hand if you were impressed by the ability using this concept of watching price and what is it reaching for, how we can go right to these very specific candles and understand that the market will want to go to them for the express purposes of delivering for liquidity's sake, where it fires once this candlestick hit this candlestick high right there, any liquidity at that price, every one of those orders become what? A market order. To do what? To be a buyer at the market. Why would that be useful? Because if anyone was long here, they have to have liquidity to sell to. So when this algorithm books price to that tick right there at that high, anything at that candlestick's high or any one of these here, that buy stop becomes a market order to buy at the market. Every order that trips is a market order. Now, a limit order says, I want to be buying at a market, but at this price or better. But it's still a market order. It's asking to be tripped right now. That's liquidity. I don't care about the split above old highs. How much is it for buy stops to be in a new long position or getting out of a short position? I don't care about that. I don't care to know what bookmap or any other instrument out there says how many orders are resting. I don't care about level 2 data that says this order, because they're all spoofed. Every big, large institution can put those numbers out there when we're trading away from it, and they're going to try to lure traders in there. It's a manipulation. Why am I going to look at something I know can be manipulated? I don't have any faith in that stuff, and I don't need it. Did you see me use any of that information describing what you just watched today? No. I didn't use any of that stuff doing those trades that worked circles around everybody else today on the social media. I guarantee you, no one put down those numbers. No one put down those numbers today. Nobody did. Period. But I can do that every single day, even in ugly days. But it's not important for you to be able to do that right now. You just need to be able to find out when it's not like this, and when the ranges, the individual candlesticks, are a lot more liquid and fluid. They just run real far and they leave gaps. And it runs to pools of liquidity that are obvious and easy to see in the marketplace. Because that's important to be able to observe that. As soon as you can start to observe that, you'll know when the market's really nice and it's easy to get in and find setups all day long. But when you know you have to work for it like this, that's the That's the surest sign to drop your leverage down to just one micro lot. Because chances are you're about to lose money that day. But you don't want to hear that. Students of mine don't want to hear that. People out there that just want to come in here and sample from my table and get some things for their mentorship, they don't want to hear that. They're never going to tell their students that. But I'm telling you, that's exactly how you progress and you learn properly. Because you want to be in these environments like this, watching price, because that's what makes you better. That's why I know everything about what price is likely to do, because I've seen 32 years of it. I've watched these candlesticks paint. I've worn my eyes out looking at them. And I know what this algorithm, clearly, look at it. Look, come on. Come on, admit it now. Either I'm really, really good at reading price action and buying and selling pressure, which to me is an impossible feat, because how can I know how many people are going to be buying and selling? How could I know that? Nobody could know that. The algorithm itself doesn't even know how many stops are above or below these highs and lows. It doesn't know that, but it doesn't need to know that. If you're playing baseball and the batter behind you hits the ball and it's going, it looks like it's going to go out into the stands, and you're the only player on base, you're on first. As you start to run, is it a stretch to believe that there's going to be a guy at the home plate that's wearing a mask on his face? Chances are, yeah, two of them, an umpire and the catcher. That's something that's going to be there. You know it's going to be there, okay? Well, in price action, you're going to start seeing these things that repeat all the time, and they're always going to be there. They're very specific, generic things. Some of them are going to be so much more impactful for you as a trader that are going to be less impactful or more significant to others. Don't try to compare notes in that regard. When you're brand new and you don't know what you're doing, the worst thing you can do, and this is why I didn't want to have students being able to talk. And they say, oh, he's running a cult. He doesn't want the people talking. Because if you're deaf, dumb, and blind, okay, and you're being taught something, and the person next to you is deaf, dumb, and blind too, how are you going to help that person? It's the blind leading the blind. And your confusion could be contagious to the person next to you that never had that concern. And now they're like, oh, yeah, I never thought about that. That's a problem now. No, it's not. You should be isolated in your own study, in your own journal. That's your laboratory. Monster Lab is in your journal. That's where the real learning takes place. What you find as a barrier, how you formulate these barriers and how you overcome them, that occurs in that journal. Because you can hold yourself back with all the toxic what if thinking. I never do this right. This should have happened sooner. Yeah, I watched this video. ICT is a scammer. I should have knew better. I should have never put this much time into this stuff. Nobody's making money with ICT stuff. When you know that that's not true. But you're just looking for an excuse not to study, not to be diligent about it. But by having an understanding of what this looks like here, all this back and forth price action. Yes, it's delivering where we were looking for. Every single one of these individual buy stops, every single one of them were hit. But when you have a very fluid delivery of price action, where the market's just really sweeping with its runs higher and lower, and it creates these really nice, easy separations between the candles. You're not seeing that here, but it's not impossible to trade. But would you want to trade in an environment like this, between this high and this high down here? Would you want to trade in that environment or something that's a lot more opened up between every individual candlestick? Clearly, this looks probably hard to you. And if you think and feel that way, that's normal. That's exactly how you should identify it. It doesn't mean it's impossible to read it. It doesn't mean it's impossible to trade it. It just means that this is going to require a lot more skill than you have right now at the moment. And as I opened this session up, I told you that this is an environment where I'm not willing to take trades on this because I can't frame it where I have a stop that's small and not see it come down and spike into it. I was honest in this live stream, but I was also honest in telling you exactly how the fuck this thing was going to deliver to these buy stops, and it went right to them. Period. Where I was wrong was I wanted to see it spike into that blue area. I did really want to see that, but the sell side down here, I failed right there too because it didn't give me what, that little bump up in the consequent encroachment. But had it done that, I would have been peacocking. But you got to take your victories, and the way you would do this is if you did this on your own, you would say it was fascinating to see how it went above this high here, and it took that liquidity, and it created small little short-term highs that reached over here inside of the dealing range from this highs here down to the low here. But can you see now how when you look at my executions and you see how my exits and my entries are always at the lows and the highs? It's because I'm looking at price just like I've taught you here today and how I'm teaching you all the time. The liquidity here, I know when it drives down below that, chances are we're going to still gravitate around that blue pair of lines that's this buy side and balance sell side efficiency over here. Because it's just hanging around there. So it's going to take what? It's going to take a real move to get away from that. So we don't know if it's going to take this buy side yet. You don't know if it's going to take the sell side yet. So what did I have to tell you? I have to sit and wait. I got to wait and watch what it's going to do. And what did it take first? The sell side. Now we want to see what does it do when we get back up into here. Does it start to build support on all these individual levels here inside this buy side and balance sell side efficiency that's been graded? Sure it does. And it gets above it here. We want to see it come back down and touch this high, which is this candle's low right there. That's the high of this buy side and balance sell side efficiency. And then it starts working its way up to this buy side. And then when we watched it tank down here, I said, now watch and see, do we start taking out this high? And we mapped out every new dynamic buy side liquidity pool. And I told you these highs are factored in. And these are only being factored because as you take out the dynamic high that's going to frame the new buy side that's building constantly, above it, you're going to have to look inside the range here. So every little short-term high and any inefficiency, that's where your eye goes to. In the beginning, you're going to feel like you don't know which one to pick. And that's okay. That's all normal, Caleb. That's normal. But watching my examples and watching how I analyze the charts and even the old videos now with you studying it like this, they're all going to start making a whole lot more sense to you. I can't tell you how many times I get people from my 2016 mentorship group that tell me that they have such an epiphany now. Their level of understanding has really clicked just in the 2 months that we've been doing this. Because I'm taking you into things that are very specific. But what they don't realize, it's just because they spent more time looking in the charts. And some of other students that are brand new, that usually these are the comments that I block you when you say these things. You're just making it confusing, or I'm confused. If you want to make those comments, trust me, I'm never going to see another comment from you. That to me is someone that's complaining. If you're complaining, that means you're not studying. Because if you're studying, you're going to find the answers. These videos sometimes are very, very long, but they're also answering a plethora of questions that I know that are building up. And every question you have may not get answered in the next 5 or 6 videos you watch, but you'll have more learning and more foundation. And then sometimes you get you get your own answer in your own charts. And that's a really good feeling. Because if you're watching price and you're studying around certain ideas and characteristics that I'm teaching you that tend to repeat every single day, when it happens in your own hands, you're going to doubt it. But it's going to feel great. You're like, wow, wait a minute, it can't be real. Did that really happen? And then eventually you'll get to a point where you hear me talk about it in a video and you're like, oh, I had that happen. Oh, yes. And it feels good. Why? Because I didn't show it to you in a video beforehand, but because your study, you observed it. That's progress. When they occur, you should celebrate that in your journal. You should really feel good about that and really cheerlead it. It doesn't mean go on social media and tell everybody you think that would be impressed by that, because they're not going to be impressed with that. And that's not going to help you, because it's going to make you feel like, well, wow, maybe it wasn't that big of a deal. Don't invite the social media into your journal. Don't invite social media in your progress, period. I'm not staying on Twitter. I'm over there just to fan the flames. That's all I'm doing. I'm having fun doing it. But nonetheless, it's my playground. But you shouldn't do those types of things. That's not essential. It's actually not good for you. But because I'm set in my ways, I'm an old dog. I don't want to learn any new tricks. I know all the tricks. Okay, you don't. You're trying to find yourself as a trader. You're trying to find yourself as an individual and how you're going to engage with these markets. And you want to remove any chance of any toxicity, any kind of influence, whether it be initially thought as good or bad. And when you find your model, don't even expect me to chime in on the market you're trading because I'll mess you up. Because I have all kinds of models. I could be doing all kinds of things. Clearly today, look at what I was doing today. I'm certain, I haven't gone through Twitter, but I'm certain I have students that probably will show me examples of where they actually executed and did similar things. And then there will be others out there saying, I took the exact same trade, but they're never sharing that. So unless you're willing to share it, if I see your comment, I'm going to say, show me. And if you didn't do it, you're going to feel real embarrassed. But there's going to be people that say, I don't know how you did that. Where'd you get that from? How do you're hiding something from me? And I see, I'm not hiding anything. I'm doing exactly what I teach. We're working with price action. We're trading inside of ideas that tend to repeat over and over and over again. But the first primary function is price is not going to move until it's time for it to move. I don't give a shit who tells you what, okay? That's the fucking facts. They ain't painting it like I painted it today. They ain't explaining it to you. They're talking all this nonsense. Nonsense. I'm going to tell you why that candlestick's going to do it. I'm going to tell you why that candlestick shouldn't do it. And that logic is going to repeat every fucking day, every week. It ain't going to change because it's scripted. Unless the hand comes in and physically manipulates it, that's manual intervention. That means everything goes out the window. Nobody's able to foresee that. Nobody does have that ability. When they go in there and they manipulate price and they just say, okay, it's time for this thing to move 150 handles because something just happened around the world. We used to have surprise rate cuts and rate announcements and increases. We used to have that. Some of you don't even know what that is. But it would cause the market to like, what the hell just happened? Oh yeah, the Fed just said, well, surprise, we're going to do a 50 basis point cut, or we're going to raise interest rates a full basis point. Where the hell that come from? Yeah, you got it easy right now. You got it real easy. Everything's going by the TV guide, which is that calendar. But you have to be aware of what's going on around the world because things are about to pop off and your whole world is going to change like that. And you're going to see it visually represented in these charts because it's going to look like an earthquake just hit. And if you're in the market, and if I'm in the market, we're going to get hurt. And that's an underlying risk that you have to be aware of. And nobody's talking about that as a mentor. But I am. And they can call me a chicken little all they want. But who's been calling this shit since 2016? I told you Trump was going to be president. I told you they were going to use him as a fall guy. I told you that they were going to do this stuff in 2019. And it was going to affect everywhere. Mm-hmm. So a whole lot of stuff I said. Just look at those old videos or recordings on YouTube. I don't put my Twitter Spaces on my channel, but you can find them. Just do a search on YouTube. There's several channels out there that are posting them, and I don't care. I don't want them on my channel. But my stuff, I'm batting 1,000 in geopolitical crap. I can read the tea leaves because I have faith. And this stuff's already been pre-written. And that's what I'm using, that prayer and discernment. But in the markets, we have static things, things that tend to repeat because they're designed to be this way. And when you have things that are visible, that you can measure statistically and probability, that it tends to repeat on this day, it tends to do these types of things. This time of day, it tends to do this thing. And when you have these expectations in price and it's not doing that, it's telling you something. It's telling you that it's not doing what it normally would be expected to be doing at that time. And there's so many examples of that in my mentorship that I could talk for 6 more hours, and some of you would love for that to happen, but I don't want to because I already talked longer than I should have. it never works out like I wanted to do. Like I've never been able to come out here and just do these really short ones. I don't have the ability to do it. I don't know what's wrong with me. But there's nothing wrong with you, ICT. Talk, baby, talk. Get that podcast going. the the takeaway is this: while this might not be something you would trade, and I admittedly I was not interested in trading it, it doesn't mean that I can't see what it's going to do. And that is not failure. That's not being fearful. That's you seeing me tell you in advance this is a tight, not a very fluid market. So that means it's going to be all this back and forth fuzziness. It's this real. I don't want to say chop because it's not choppy. Everything here is a rhyme and reason. When somebody says, "Oh, the chop is real," that's what they're saying because they don't know what the fuck's going on. They have no idea what price is doing. They clearly do not know. If they are saying, "Oh, it's just really choppy," and I have students that are live streamers that'll say, "Oh, it's just really choppy," that just means they haven't learned this part yet. They will. They'll get better at it. But if you feel the impulse to say that, don't. Stop saying those words. Stop saying them audibly. Stop thinking it. Do not use those words. Oh, it's getting real choppy in here. Oh, the market's just really choppy. Don't do that. Don't do that. Because what you're doing is subconsciously, you're giving yourself an excuse. Because you're expecting to be right about right now. And you have to relinquish your death grip on the marketplace and say, you know what? What's it going to reach for? That's all you have to do. Take a step back and say, what is it going to reach for? Where are my inefficiencies? Well, if there's a lack of any inefficiency, then you have to go down to what I taught you here. Stick to just the buy side and the sell side. That's it. That's it. That's all you can do. Or turn the charts off. But while you're learning, don't do that. You want to be looking at the market when it looks like it's hard. Because that's going to be how you recognize when you're in a market, when you think it starts off in the day at 9:30, the bell rings, everybody's chomping at the bit. There might be a big gap. There might be all the things that look like it's going to be a wonderfully easy trading day. Not every single trading day is a profitable day for a new student. That's not true. And anybody tells you that, they're blowing smoke up your ass. That is a lie. Just like the people that tell you you need to learn how to trade with real money, even if it's a $100 account. That's fucking bullshit. I promise you these people can't consistently go out in front of you. They won't go live stream and they won't tell you anything about the market before it happens. They won't do that. They'll do a lot of jawboning, but I'm giving you principles of what you're focusing on. So while I might talk a lot, I'm giving you tons of diamond dust. This is stuff that I had to lose my ass over, losing lots of money before I got it in my head. Oh yeah, this is how I should have been doing it. This is how I should see it. I wrestled with it more time than I should have. And some of you don't want to listen. And I don't want you, Caleb, doing that stupid shit because your progress will be much longer than it needs to be if you resist this stuff. If you go through the process of saying, you know what, every day is a price action study day. Even if it looks ugly, even if you think it's bad, that's when you dig in. But watch and see, if you ever have the time, you're not trying to be in front of the charts, look what the chats are in live streams. When there is choppy conditions, when it's doing things that's not real fast market, you'll hear them all bitch and moan. Well, you'll see them actually. You won't hear them. They'll say, "Oh man, f this market. This is bad. This is so bad." That's a wonderful opportunity for you to dig in because they're gonna always be stagnant in their progress. They're never gonna make it any better because they're gonna gamble on every single day until they realize, okay, the market's beat me today. Versus you being able to read it and say, oh yeah, this is doing what I need to sit still. Strip it down to where's the inefficiencies. If I don't see any inefficiencies, okay, focus on where's the stops. And it's going to be basically like a ping pong. It takes the sell side, then it runs to the buy side. It goes to the buy side, then it runs to the sell side. That's all it's going to do. It's not going to go a straight line. Even when it barcodes, it's still taking minor buy side and sell side. And that's still a study that's worthwhile. Because what that does, it reassures the person that's insecure inside you as a trader that you're trying to protect from hurting them rather. I don't want my inner self to have a losing trade. I don't want them to get it wrong. I'm going to protect them. Wrong. Absolutely wrong. You need to be out here and roll your sleeves up and feel what it feels like to be uncomfortable when the market's not doing what you want it to do. And if you run away from it thinking, it's not for me today. See, that's how it was on baby pits, because I didn't want to teach people on baby pits this stuff. I didn't want to do that. That's what makes me good at reading price. That's what makes me good at putting myself in at the highs and the lows. That's what makes me good at being able to pick the daily low and getting at the highs. That's what makes me good at that. Because I went through all the mud of watching when it's ugly. And nobody wants to be in that stuff. Fast markets, easy, fast runs. Oh man, give me that. And as soon as they can punch the clock and get out and run away from the markets, they're doing it. Not me. I was in there until it closed. And I'd be up all night long looking at it on Globex. I'd be there constantly looking at these markets overnight, watching the currency futures, watching the Swiss franc and the Deutschmark, looking at all this stuff, taking in new information, wrestling with uncertainties. But the constant things that I would observe are the things that I teach. These things are constants. They're not variables. And you have to be constant about how you think about yourself and what you're trying to do. If you are constantly like a variable, what you're trying to trade, you're always trying to pick a new PD array, you're always waiting for me to teach something new. The only thing that's being introduced new is an entry mechanism. Everything is still the same. The market's going to go up based on the same principles. The market's going to go down over the same principles. The only thing that's changing, the only thing that's morphing and becoming more information is that I'm teaching new entry mechanisms. That's all. That's the only thing it's been added to that core content. That's the only thing that's happened. But some of you, because you've been studying a little while, you feel like you have learned something entirely new. Everything I'm teaching here is everything I taught in core content. Everything is there. The only difference is you have a little bit more experience, and now, I just had that moment that I told you, if you keep pushing at it, you'll eventually have that moment of astonishment, that epiphany, that I finally got that aha moment. And then suddenly you know how to trade. Suddenly you know what your model is. Suddenly you know how to put a stop loss at the right place and never rush it to strangle the trade. You'll have all these things figured out. But that doesn't happen fast. And that's why a lot of people that come to me don't stay. Look at the numbers on the video at the very first one of the 2024 mentorship. It's a lot of views on that first one, right? And then the second one's less. The third one's less. And then they'll say, well, you talk too much and you don't get to the point. The point is you need to know all these things or you're not going to be fucking successful. That's the point. The point is I want my son to be successful. I want my son to know everything that I know. I don't want him to have a one-trick pony approach. Silver Bullet, that's a one-trick pony. Cameron's model, that's a one-trick pony. My daughter, 2022 mentorship, that's a one-trick pony. Optimal trade entry, that's a one-trick pony. You're trapped in that. And if it's not fitting you or your personality, you're going to struggle. But I would toss those out there because I know some people may gravitate to that. But the real students are going to go through this one first, the 2024. Because this is where the rubber meets the road. You're in the trenches out here in real price action live with me. And the things I point to, it's happening. Why it's going to do certain things, it's happening. And no one can say anything about that. They can't argue it. It's exactly what it is. That's why I say I could do this on CNBC. They could have a 15-minute spot where, kick Kramer's ass off of there. And I'll tell you what the S&P and the NASDAQ and any other market, ICT's markets, okay? And I could be up there. I'd probably get even richer doing that. I'd give them ratings. You'd watch me. Don't fucking lie. You'd watch me. You damn right you'd watching me. I'd get my little sound buzzer buttons over there. Buy, buy, buy. Sell, sell, sell. But it'd be me saying all the words that you don't like hearing me say. And with the little beep, 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 beep. Cussing. F-bombs. But anyway, I'm rambling now. But that's why I'm a rambler. I want you guys to think about what I showed you here today. You don't need to listen to all this part, but watch the part of what we were looking at, how price was booking, how it was delivering, reaching for those buy stops. Okay? I just remembered what I was saying earlier and I didn't finish my thought. when price is inside of inefficiencies, like fair value gaps or volume imbalances, I don't want to see price stay in them. If you notice that the market's staying inside of inefficiencies, you have to take a step back, because now what you're seeing is time distortion. That means the algorithm is in a holding pattern. It's not going to move fast. It's not going to do something crazy and squirrely. It's just simply going to keep grinding sideways. You're going to hear Patrick Wheeling and the people like him are going to go, oh, man, this market, oh, the chop is real. You ought to make a t-shirt, Patrick. Just get a t-shirt. The chop is real. You'll probably make money off of that. But when you see people do that, what they're saying is I don't know what the hell's going on, and they're frustrated. But I'm teaching you, take a step back and say, okay, where are the inefficiencies? If there's no inefficiencies and it's staying inside of the only inefficiency that's around price right now during this time, that means the market's in a holding pattern. The markets are simply being controlled and held in time distortion, meaning it's just marking time. It's not meant to make a new range high, which would take that short-term high out here, or take that low out here until it did it. Once it did it, what time of day is it happening? During the 250 to 310 macro. See that? It's about price. No, it's about time, motherfucker. So it drops down, sell side's taken during my macro. And then, because it took sell side first, and we're in a consolidating market, the chop is real. What's it going to do? It's going to explore the other side of this inefficiency. So where's the focus at? This high, just like I told you during the live stream. So it took sell side first. It's reasonable to expect it to go up here. It did it. And then I outlined every individual one up here, all the way up to that high right there. And that high, look at the high of that candlestick. Its price is, let me move this over so you can see it. It's 19,000. Well, of course it's going to be whatever I'm hovering over, but it's this value here. The H, that's this price right there. 19,551.75. 175. And this one here is 52 even. So it went one tick above it. That's enough to make all the orders go what? Hot. So any market order at that high or just above it tags it. And they become what? A market order to flood the market with willing buyers at a high price, which is exactly what smart money would do by being a buyer of these sell stops down here. They want to offload it above this high. They want to offload it above this high, above this high, above this high, and then finally hit it there. And then what does it do at 3:55 during the 3:50 to 4 o'clock macro? That's the settlement macro, market on close settlement macro. It spools. And what's it spool for? Opposing liquidity. What did it just do up here? It took all the buy stops and then race down the sell side. That's scripted. It has absolutely nothing. It has fuck all to do with buying and selling pressure. And the sooner you start looking at price like this and you strip it down to when are these moves occurring, that's the main thing you should be focusing on. The time these things form. Don't listen to these broke fucks that don't know what the fuck they're talking about. They have no idea what they're talking about. I promise you they don't know what they're talking about. They like to talk and bloviate like they do, but they have absolutely no idea what the hell's going on. I was in there buying and selling all fucking day long. Up, down, up, down, up, down, all over the fucking place. Smashing it. And that's still nothing. That's nothing. that's nothing. That's literally nothing. And when you understand this, you can do exactly what I did today. You can do what I did today. Every single one of you that are learning how to do this, what I did today, it's in your hands, and it's something that I believe every student of mine can do that. But you have to spend time learning how to do the things I'm teaching. You won't do it in your first year. You won't do it in your first 5 years. But eventually, you'll get good enough that you can go in there and buy and sell in the same day and trade without a bias. You don't need a bias. But because I'm an educator, I teach people to focus on certain days because the bias is obvious. So it's easier to find a buy. Just like it was easy for me to make money when I first started trading. It was me buying in a bullish market. Well, shit, anytime it was oversold and I was buying it because of stochastics crossover, it was going up. And that's not skill, but that's what you see still today on social media. When they do something right, they have no idea why it happened, but they want to say it's skill. and they go online, they brag about it. I'm showing you something that is totally different. It's technical science, and you don't like it. If you're selling something, if you're trying to get attention, and it's not using this information here, or you don't want to be dubbed as, oh, I'm an ICT guy. You don't want to be a cult member. Woo! That's good. That's you, baby. You do you. But it ain't changing what I know. It ain't changing what my students can do. Nothing's gonna get as good as our stuff. It ain't gonna be. It's no one's gonna be able to step to this. No one. I've been begging for it for years, and still ain't happening. You ain't never gonna see somebody out there explain this. And Al Brooks keeps being brought up, and I simply cannot stress it enough. I don't use his stuff. Okay. Tom Hugard, who I like, his mentor was this guy, Al Brooks. And I asked him point blank, I said, listen, I had a guy say, I'm teaching Al Brooks stuff. He goes, no, Michael, I've seen what you're doing, and that's not nowhere near the same. I'm not saying go harass Tom Hugard, but I'm just telling you that's a guy that was his mentor, right? So I take it on good authority that if he's telling me that, I don't need to go and start watching his stuff because I don't have the time to be watching other people's bullshit. Nothing against the man. I'm sure he's probably a nice guy, but I'm certain that there's nothing what I'm doing. You're not going to find it somewhere else. You're not going to do that. It might have similarities. Oh, it looks like this. It looks like that. It's not the same thing, man. It's not. I'm doing shit on time. I'm doing things on very specific elements. And there's also a lot of things that I've done in the past that have absolutely no bearing on anything I've taught because I can't teach that to you. That's enigma. That's the stuff that where it's just too good to be taught. And that's what you think it is when I'm doing really good trades like today. You think that was enigma. I facetiously ribbed my private mentorship students last night. So I think I'm going to turn enigma loose today. That was not enigma. That was just discretionary trading, buying and selling without a bias. And that's something that you can do. Using the information that I teach on this channel, you absolutely can do it. But here's the thing. You have to go through the process of watching what you think is ugly, baseless, aimless, choppy price action. That's how you get good. Because if you can recognize it when it's doing that, don't call it, oh, the chop is real. Don't say, oh, it's just chopping around. It's just hurting people. It's marking time. That's all it's doing. It's building sentiment. That's exactly what the algorithm is doing. That's all it is doing. Meaning that it's just staying in a predetermined range, this high and that low. It'll just bang around this inefficiency that's shaded in the blue lines. It'll hang around there, but it's not going to go in a straight line sideways. It's still going to go to very minor buy side and sell side. So what you're doing is you're waiting for the time of day, 250 to 310, when it will do what? Spool into liquidity. What side did it take first? Sell side. So you flip it and say, okay, now it's going to go for buy side. How fucking hard is that? Is that complicated? You're telling me that that's a complication? Because if you think that's complicated, trading is not for you, man. Because that's easy shit. That's real easy. It's taking buy side, then it's taking sell side, or it's taking sell side and it's taking buy side. That's not some joker's model. That's just simply looking for the first side of the market taken, then the other side is going to be aggressively moved on, meaning that the sell side was taken first. The time of day when the market should start running around, okay, well, 2:50 to 3 o'clock. Do we start seeing the market reach for the buy side then? Yep. During the 3:15 to 3:45, we're creating buy side here. The market drops down, disrupts this area here. What is that? Opposing, because it took the buy side here, right there on that run. So this high is taken there, and then it drops down, taking that short-term little low out. Then it rallies up, and in one good time deeper. Why? Because this was a little too shallow, and it was this old inefficiencies high, that blue line. So it's going to dig a little bit deeper. Did it touch the consequent encroachment level? No. No. So what did I teach you? If it doesn't touch my PD arrays, if it doesn't hit them, if it fails to trade them, is that giving you any information? You're fucking right, it does. It doesn't go down and touch it, so that means it's really bullish. It's not bearish. It's going to go where? Another level of buy side. That's why I'm telling you this high, and if I could have got a little bit of blow off and I'm a little pissed off. I'll be honest with you. I really wanted to see this little candlestick go and just touch the low of it. If it would just touch the low of that, that would have been wonderful. Because I knew it was going to run back down here and take this out at the end. And I knew that's a struggling point for some of you. Nobody knows what the price. Michael fucking Huddleston knows exactly what the fucking price is going to do. I know exactly what it's going to do. Okay, in case you haven't noticed it. Okay, I went out there a few months ago and I trolled these motherfuckers. Okay, and I went out there and just clicked the buttons and said, "Oh yeah, I'm going to try to do this. I'm going to try to do that," and you fucking clowns believe it. You're literally going around in my comment section and other people. Oh, he went out there, he tried, he failed miserably. Dude, are you fucking serious? Look at the fuck I'm doing out here. I'm calling every individual candlestick and then I'm executing on it and showing you exactly what the fuck's going on. Come on. Cook my ass. Get the fuck out of here, bro. So if you start looking at price around times that I'm teaching you, every single hour, there's a 20-minute macro. Now, certain hours of the day are not going to be all that energetic. They're not designed to be energetic, but they're going to be checks and balances that disrupt or entice a little bit of sentiment or purpose for bringing in the liquidity. That's all. Do you think that the 10:50 to 11:10 p.m. Eastern Standard Time's macro is going to be as impactful than the 7:50 to 8:10 p.m. Eastern Time macro? That's Asian session stuff, okay? I'm telling you about the weakest time of the day, the shittiest time of day. I'm not interested in that. But for the folks that are just working class hero guys like I was when I came up, you work all day long, you come home, you hurry up and get something to eat after you get a shower, and you're like, okay, I want to see what the markets are doing. You want to trade Forex or you want to trade the indices when they open back up at 6 o'clock. Don't open up the charts at 6 o'clock and try to trade right away. Don't do that. Around 7 o'clock, see if it wants to overlap over top that new day opening gap. But when we get into 8 o'clock, that means 7:50 to 8:10, that's a nice little area to anticipate that 8 o'clock macro. It's 7:50 to 8:10. Then you have it again at 8:50 to 9:10. Those two macros are really nice. And you can take a little bit of a small little piece out of the marketplace in every market, whether it be a Forex pair. If you're going to trade Forex, you want to trade these very specific. And in fact, if you're going to be doing Forex, this is different. This is something very specific for Forex. The 6:50 to 7:10 p.m. Eastern Time, that macro for the Aussie dollar, the New Zealand dollar, and the yen and the Swiss franc, they tend to do very well during the Asian session. So if you look at like 6:50 to 7:10, there's usually a little bit of a small micro move that you can do there. You get 10, 15 pips out of the market doing that, easy, sometimes 20. But when you get into like the 7:50 to 8:10, indices and Forex pairs can give you like 20, 25 handle runs in that time, in that macro. Same thing happens in the 8:50 to 9:10, both Forex and index futures. That one can deliver anywhere between 15 to 25 handles. Now, it's not the same thing for pips. Pips are, you're not going to get that big of a run in the pairs on Forex. You might get like 10 or 15 pips, but 10 or 15 pips, if you're going in there surgically and constantly getting them all day long, you can run up 250, 350 pips a day trading these things. And one contract basis, that stuff grows your account. So every single hour there is a macro, but the 11 o'clock one isn't going to perform the same way. But the 11:50 to 12:10 macro, that's fucking dynamite. That is wonderful because what you're doing is you're getting the beginning of true day. True day is midnight New York local. What the hell am I doing? I'm teaching too much shit here in one day. Have yourself a good weekend, and I'll catch up with you next week. No, 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 shit. No. Yes, this sounds like a motherfucker that loves what he's doing. Suck my ass, little bitch on TV. What is it? Twitter. What's his name? Stoic. I said your name. Now you're fucking famous. Get the fuck out of here with your bullshit.